Citizens of the world, welcome back to another Keep Yours podcast where we try and keep a few extra dollars in your wallet. Today we are discussing what is a better investment for me right now, this year, a Roth IRA or a traditional IRA, or a contribution to my Roth 401k or my traditional 401k. What's the difference? What are we talking about here? Now, I've seen a lot of stuff on social media lately, whether it's Facebook or Quora and in groups, where fundamentally it seems like everyone's decided that the Roth IRA is the supreme being product and that's where everyone should put their money. And if you're a young professional and you start making more money, this could be a bad decision for you. So fundamentally, I want to talk about what is the difference. And the difference is what we refer to in the accounting world as tax planning. This is a tax planning question. Tax planning, the whole purpose of it is to pay the lowest amount in tax. That's why we're planning around tax. The tax planning is, how do I pay the lowest amount of overall tax? Which means the big question on a Roth or a traditional IRA, the one big unknown. We know what our tax rate is today. So we know either the deduction that we're going to get and not pay taxes on them if we defer money into a traditional IRA or traditional 401k, or what the tax rate is that we're going to pay first before we put our money into a Roth IRA or a Roth 401k. That's fundamentally known. We know what our tax rate is right now, although we're going to get into that because you may not really know. So now, the question is, what's the tax rate going to be when we retire? And no one has the answer to that. There is no crystal ball. However, and furthermore, had you told me 10 years ago that tax rates would be lower today than they were 10 years ago, I would have thought that was crazy. No one thought tax rates were getting reduced. But enter the Donald, and here we have it, lower tax rates. Is that a good thing for the country? I don't know. Lowering the corporate tax rate overall, probably a decent idea to compete so we stop having companies move offshore. But individually, I'm pretty sure that the benefit went to the really wealthy. So what do you do? That's what we're talking about today. So before I can tell you what the best decision for you is, first I need to introduce you to how taxes work. So without further ado, let's get into that. So here's how taxes work from an IRS perspective. The first $12,400 that you make, you get a standard deduction for. Now, we can get into itemized deduction stuff that makes it a little more complicated, but we'll just keep this discussion simple for today. If you're doing itemized deducting, then you're savvy enough that you can go through this exercise and see the exact same marginal rates. It's just your deduction is going to be slightly different. So for everybody, the first $12,400 you make, or $24,800 if you're a couple, that's not taxed at all. That's tax-free, 0%. Okay, so we're going to build a worksheet up where we're using this info, and I'm just going to build a brand new one. That's the worksheet long-term we're going to use. Instead, I'm just going to create a new one here, and we're going to build this together right now. For those of you just listening on the podcast, I'm going to walk you through it anyway, so hopefully you understand. So the first, we're going to treat this as a single person. Married, basically, you just double everything. Okay, so we're going to say that you're now making $100,000 a year. Congratulations, you've moved up. You're making more money now. That's fantastic. So you make $100,000. The first $12,400 is a standard deduction. So we put that in there. And now we only have $87,600 of what we're going to call taxable income. Okay? So then we're going to break that down into our brackets. All right? So we're going to say, hey, how does the brackets work? Well, how does this marginal tax rate stuff actually work? And the IRS kind of lays it out here for you, but if you're not used to looking at it, it might be a little confusing. Okay. So the lowest rate is 10% for incomes of single individuals with incomes of $98.75 or less. And they basically, again, they just doubled it for married. Okay, so we're going to go with the single rate. So that means the first $9,800 $9,875 is, we're going to call this rate 1. $9,875 is at 10% tax rate. Over here, we're going to have what our taxes are. Excuse me. So on the first 10%, the first $10,000, sorry, we're going to pay 10% in taxes. So that's $987.50 we pay on that first rate. Okay? So then what do we have remaining after that? We're just going to call this remaining balance, which is our $87,600 minus that we paid the rate on. And this is how marginal rates work. And they work the same for all of us. So for incomes over $9,875, but less than $40,125, we're going to pay 12%. So we're going to call this rate number 2. And that rate is $40,125 minus $9,875 is the amount. And that rate for us is 12%. And I need to change this column so that these show the percentage. So the tax on that is $3,630. Once again, we need our remaining balance of what we owe taxes on. So we still owe taxes on another $47,000. Okay, so then the next rate, rate 3, is 22%. And what do we owe that on? $85,525 minus $41,125. Put something in here wrong. There it is. And we'll have our remaining balance again, which isn't much. And rate number 4 is 24%. So you can see how these rates keep increasing. So in total, for someone making $100,000, they're going to pay $15,000 in tax. So here's where this gets confusing. You think, I'm paying $15,000 in tax, so my tax rate is 15% on my $100,000, which if you look at a total tax rate, you're 100% correct. However, when we're looking at, do I contribute to a Roth or do I contribute to a regular IRA, we are not looking at our average tax rate. We are looking at our marginal tax rate, which means the next dollar amount that I make, or another way to look at it is the next dollar amount that I deduct. So if I take an IRA contribution of $5,000, that $5,000, the first $2,075 of it is going to come out at off of 24%. That's what it saves me. It saves me 24%. So if we're looking at pay now, pay later, what is my pay now? Is what is the next dollar of tax cost me? The next dollar of revenue, what's my percentage I'm paying on that? That is your marginal rate. So when I'm deducting dollars now, if I say, hey, if I'm putting that money into a Roth, then I pay 24% on $2,000 of it, and I pay 22% on the rest of it. If I'm taking the deduction, those are the rates that I'm deducting. I'm not paying 24%, right? So it's getting the confusing part where you think, hey, my rate's 15, my average rate is 15%. So if I'm only paying 15%, well, then I should contribute to a Roth. This is where the math messes you up and gets you wrong. So that's the tax rate part you need to know. The second piece of that is, what's the difference? So if I put money into a Roth IRA or I put money into a traditional IRA, if we use the same rate of return and the same contribution amount. Now, if I have to pay taxes first, That means that I have to pay taxes on the amount before, so I don't have the full thing to invest because I already paid the taxes. So if I have $5,000 to contribute, if I put that $5,000 into an IRA, all $5,000 is there. If I put it into a Roth, I have to pay my tax rate, right? Now, the other rate that you need to figure in here is state rate, and I'll finish that at the end. But for just the federal rate, we're just talking about same rate, if you put in the same amount and you pay taxes today and your tax rate at retirement is the same as your current tax rate, then when you get down to the bottom of this worksheet, because this is going to show, assuming you invested it each year, assuming it returned the same percentage in both accounts, right? Now we get to the bottom and we have to pay taxes on the regular IRA. The amount that we're left with is the exact same. So if your tax rate doesn't change, if your tax rate's the same now as it will be in retirement, there is no difference into putting it into a Roth or an IRA in terms of the amount of money that will be available to you long term. It's identical. So this is why this is a tax planning question only. And as you'll see over here, if your tax rate at retirement is less than your current rate, then it's going to be much more advantageous for you to put the money into an IRA versus a Roth. But if your tax rate is going to be higher at retirement because you currently have a low tax rate, then the opposite is true. Then a Roth is more beneficial. So again, the only thing that we don't know is what that tax rate is going to be in retirement. However, based on that worksheet we just did, are you going to make, if you're making $100,000 now, are you going to make $100,000 in retirement? And remember, this is you single, not married. So if you're single, this is your rate. Okay? Now, if you get the max Social Security, so you wait till 70 years old to take Social Security, the max you're going to get is about $36,000 a year. So you're going to get $36,000 plus the amount that you take out of your IRA. That's your taxable income, unless you have other investment income coming in. What are the odds when you retire, if you're making $100,000 a year, that you're going to make more in retirement? That you're actually going to have taxable income higher? Remember, that first $12,400 is taken off the top. What's the odds that you keep your money in these lower brackets of your actual taxable income? Probably pretty good. So once you start making more money and your marginal tax rate increases, the tax rate you're going to pay on the next dollar that you make, if you made this much money, if you got a side job and you made another $1,000, you're going to pay the 24% rate. That's what marginal means. Okay? So is it better to do that now or later? Is it better to pay taxes now or later? And the answer is, it depends on what that rate's going to be long term. But here's a general rule of thumb. The general rule of thumb is, once you start getting over this 24, up to this 24%, meaning once you start making taxable income of about $85,000 a year or more, it's probably going to be more beneficial to you to do a traditional and take the deduction now than do the Roth and pay taxes now. Odds are your tax rate will be lower in retirement if that's the amount of money you're making. And so if you're making less than that, then the Roth is more beneficial because the odds are it's going to be close to, or it might even be more in retirement if you put a bunch of money away for retirement and defer and collect the max on Social Security. So that's the scenario over which you're deciding this. Now, here's the one other kicker that may make a huge difference to you or may make no difference at all, depending on where you're at, is state taxes. So if you defer, you not only defer your federal taxes, you're deferring your state taxes too. And this could make a huge difference for someone who currently lives in a high tax state and starts making more money, like New York or New Jersey or California, and you're going to retire to potentially a low tax state. So if you move in retirement to Florida or Nevada, and you see a lot of people from California move over to Nevada. Why? Don't have to pay that state tax in retirement. So if you defer state taxes now and move to a low income or no tax state like Nevada or Florida when you retire, you saved all of your state tax amount as well. So that could be a huge contributing factor to whether or not I want to do a Roth or whether or not I want to do a traditional IRA. Now, if you think that tax rates will probably rise, but I'm also starting to make more money, so now I'm in a higher bracket, what do? Hedge your bets. Do 50-50. But I just want people to know that this idea that do everything into a Roth is not necessarily the best tax strategy. We're doing tax planning, right? So if we look at these marginal rates, and even if we think they might go up a little bit, once you get to a certain point, odds are you're going to be pulling down less money in retirement. So especially if you see these rates, if you're into this 32, 35% rate, it's a no-brainer. Do traditional, save way more money. If you're down here in the 22 and 12, Roth might be okay. Certainly if you're in the 12 and 10. And of course, when you make the least amount of money, it's the most advantageous for you to put more away. But of course, you don't have it. But if you're making a decision with even $1,000 a year and you're paying currently 10% tax and you have $1,000 you can put away, do it and do it into a Roth. So this is typically why when you're really young, a Roth makes a lot more sense. But as you get older and you start making more money and you move up into that tax bracket of your marginal rate and you start moving up into these top tiers, 35%, 32%, 24% is kind of the middle. 35, 32%, almost guaranteed at retirement you're going to pay lower rates. So do that. Pay lower rates later. That's the strategy if you're doing this. So I hope that's clear for everybody. I hope this wraps it up, that this is what you're doing. The worksheets are available on the podcast notes. You can see it for yourself. You can calculate yourself, guess what your own tax rates are, put in your federal, your state, all of it, where you're going to be now, where you're going to be in retirement. And literally, if you move states, that could be a 10% swing in terms of paying taxes in New York or California. California's top rate's 13%. So if you can defer, let's say you're paying 24% federally and 13% state, that's 37%. If you move to Nevada when you retire and you drop your rate to 12%, you just saved 15% of your money. That's wise tax planning. So if you're close to retirement, then you know the numbers aren't going to move very much on you, likely. And if you were funding a Roth 10 years ago thinking tax rates went up, you might have made the wrong bet. And I'm sure there's some of that out there. But I just want everybody to know that just saying Roth is the complete right answer is not true. This is a tax planning situation, and you need to do tax planning to plan for your lowest tax rate. If you don't plan, then you might end up on the short end of that stick. And as you make more money, you need to do more planning. Go consult your CPA once you're making $100,000 and start making different moves to not pay more taxes now and to pay less later. That's what I got for you today. Hope that clears it up. Roth versus traditional. Those are basically your metrics and your markers. Thanks for listening. Catch you next time. And keep yours.